Hi everyone, welcome to my channel. Today I'm going to share with you why the stock market is still rising despite there are 33 million people out of jobs. I was looking for an answer on the internet and I stumbled upon this is a dead cat bounce, or the stock market is usually looking forward. But it still left me confused because it missed one of the most important and direct element of the reasoning. Who is buying? In order for any price of goods or assets to go up or down, there must be a supply and demand imbalance. So whether people told you this is a dead cat bounce or technical reversal, they're not getting to the core of the problem. Who is buying to keep the price up? And we have to take a closer look at the Fed. I looked at the news announcements from the Fed as well as its balance sheet. The Fed is buying government securities as well as providing loans to banks, money market mutual funds. They also pledged to buy as much as 20% US listed bond ETFs. Some analysts say Fed would eventually extend this reach to common stocks like the Bank of Japan did if needed. So what do these mean? Essentially, the Fed is lending money to three players. The majority of the money goes to the government in exchange for its treasury bonds, which pays interest over its tenure. Government uses this money as pandemic benefit for businesses and people. The next one is financial institutions, such as the banks where you deposit your money, or money market mutual funds, in which corporations park their excess cash, because money market mutual funds are considered zero risk, provide higher interest rates than bank deposits. When corporations withdraw their money from money market mutual funds due to they can't do business right now, the Fed is going to give money to these money market mutual funds to keep the financial market flowing. The last one is the promise to buy corporate debt, basically lending money to big companies in the form of corporate bonds. Here's where magic happens. When money changes hand from the Fed to other players in the financial market, the Fed creates this buying action to keep these debt prices from falling, driving down the yield on these bonds. You might be wondering, if the Fed is buying bond, how come stock price go up? Well, when the Fed buys bond, not only does it stabilize the bond price, but also bring one other side effect. It reduces uncertainty. Stock price doesn't like uncertainty. When uncertainty goes up, people usually have the mentality of get out before it goes down type of attitude that makes the price goes down. By stabilizing the bond market, Fed is essentially saying, hey, if you're short on cash and nobody's giving money to you, I will lend it to you. This creates a moral hazard that the Fed will come and rescue the market whenever there's a problem, no matter what long-term consequence it leads to. And the market participants think that the price will be supported by the Fed. Having Fed's word, corporations, hedge funds, individual traders swamp into the equity market to drive up the stock price. Because corporations get the money to buy back stocks, hedge funds read the technicals to jump in for the bounce. Individual stock traders are more likely to be influenced by the media to think this is a good opportunity to buy low. Another way to look at it is that the investors know that when a vaccine is found or a treatment is approved, the market will go up immediately because the news will set off a big increase in economic activity. And also, they also know that when that day comes, the stock prices will be bid up very quickly. So if they don't act now, they will miss the chance. For the past 90 years, the bear market lasts averagely 21 months, with the longest post-World War II bear market being 37 months, and the shortest algorithmic recession in 1987 for 3 months. Average loss for the past bear markets is 44%, in which the lowest being 28% and the steepest decline is 86% in the Great Depression. If we use history as a reference, this could well be identified as a dead cat bounce, and the stock market declines is yet to be over. On the other hand, a bear market that drops 33% and only lasts months is not entirely impossible, since the central bank and government have grown their skills substantially over the years and react much faster to handling this crisis. Another reason for the rise is that the market leads the economy. Take China, for example, where the virus is almost under full control. Even though the economy is not yet back to its full strength and there were some small relapses of the new cases, it rebounds nicely. In the recently announced economic data, export in April is better than expected, so is loan growth and social financing, signaling the recovery of the Chinese economy. If we can learn one thing from China, it is that the virus is stoppable. So if we were able to reopen the economy, we should expect everything go back to normal gradually. So people go back to work, businesses reopens, we can go to restaurants, everything just go back to normal. With the printing of money right now to fuel the asset price can be justified if the economy starts to grow again. So now the question is it a good time to buy stock? So if you think about the reasoning behind the buying action of different people in the market, it's pretty much Fed driven, and the stock is priced in pretty much the best case scenario at a very early phase during this difficult time. We don't know exactly how long it will take before the economy reopens. So I would say the stock price right now is an optimistic price, which implies taking greater risk for less reward.